Right, yesterday's video we talked about draw on liquidity and where price is headed. Today we're going to go ahead and talk about market structure. And just in case there was any confusion, yesterday's video was actually episode 8 and not 9. I fixed it in the description. A little bit of confusion on my part, but today's video, this is actually episode 8. Or sorry, sorry. Today's episode is episode 9. Yesterday's was 8. Like now, with market structure, you're going to want to look at your swing highs and your swing lows. If you don't know what they are, go ahead and watch episode 2 again. Now, once we know where our draw on liquidity is, we're going to want to break down the market and look at the market structure, the structure of the market and price action as a whole. So we have a swing low here. Right here, this candle. Market breaks down below a swing low, comes back up, fails to get above the swing high, trades low below another low, comes back up, fails to get above the high, trades down below another low. This is a bearish market structure, which means, another word for bearish is short. Basically just the market going down. Now you can be long or you can be short. If you're long, it's also called bullish. Long just means you want to profit from the market going up. If you're short or bearish, you want to profit from the market going down. And again, you can make money from it going down or up. I'll get a little bit more into option contracts after I unveil a little bit more of just these trading concepts, since you know what you're doing. So the market is bearish. Okay, let's take a look at where the market stopped at. And now when the market is bullish or bearish, whether it's going up or down, it's always headed for something, just like we talked about yesterday, liquidity. Let's go to a different chart. Start on the hourly right here. Let me draw back to the 5 minute just so I can see where we are. So the market came down to this level right here. Notice where this level's at. Now look, I said yesterday the market trades to fair value gaps. An order block, liquidity, old highs, old lows. Look, let's take this fib from the low to the high. So that's our fib. I'll make the fib red. Now, is that random? Price just happened to come down to the fib exactly. You can't make this up like that. Price comes down to our fib level, our 62 to 79% retracement level. And now we have an order block as well. Or no, sorry, an order block. Fair value gap. But look at the size of this fair value gap. Look at this fair value gap. Now that's a pretty wide fair value gap. That's 524 down to 505, about a $20 move. Now where would you enter in this though? This is where the fibs come in handy. This is why you want to pair a fib with a fair value gap or an order block. Again, everyone should know what a fair value gap is. If you don't, go ahead and watch the previous video, not the previous, but the earlier videos. But yeah, look now. Again, I'll draw this fib again. Starting from the low, up to the high, up to that high. Price perfectly, like, bro, what? Now, for anyone that thinks the market is random, it's not. The market is not random. You can't make this up. Okay, came down to the fib level exactly. So the market moves to fib levels: fair value gap, order block, liquidity. So you have bearish market structure. We came down. Price was heading down to its draw on liquidity, and now price reached that draw, and now we're looking for a reaction. Does it trade through, or does it want to reverse? Market comes up, big retracement up, nice big move up. And also, just take a look at this right here. Oh no, hold on, let me go back to the chart. Let me go from this high down to this low. Let me change this all. Now look at this. Price comes directly up to the fib, top of the fib, and comes down. Is that random? Is that random? Is that random right there? I used to think the market was random. When I first started trading, I wish I would have known what I know now. It would have saved me a lot of pain, a lot of money lost, oh man. Well, so then the market came up to that fib level, retraced up. We had a good reaction off the level. And now let's just take another look from this low to this high. Where did price come down into? The fib level. So look. This is going to be gold right here. You should definitely have your notepad out. We have a bearish market structure. Okay. Market came down to a level where we would be expecting price to reverse. And why would we be expecting price to reverse? Because again, I already have it on the chart. Because we have a fib level. This is at 69% retracement level. So once we see, let me go back to the 5 minute. Now once we see price have that reaction, okay, this is where the light bulb should go off, where you're like, okay, let me start looking for an entry. So now price comes down. What is this candle? This is an order block. So price came down into an order block. And what is this in here? What is this little gap? This gap between these candles. That space in between this candle and this candle, the gap. These candles are not overlapping. That makes that a fair value gap. Okay. Now we drag that over. And then to top it all off, I'll make this red. So price came down, retraced into a fair value gap, order block, and a fib level. This is where you would have entered the trade at. Okay. And then price came up above this. Now you could have entered the trade here if you wanted to be aggressive. Now you could have waited. For a confirmation, like something like this. A trade above the swing high. It's all depending on you. With trading, you definitely want to find your unique style and a strategy and a way to trade that fits how you are. But again, so I don't want to go too fast. price here, it broke market structure. So price was bearish. So you want to start with the higher time frames to frame the trade, like your hourly chart, your 4-hour chart, your daily, and things like that. And then you have an idea for the trade. So we frame this trade on the hourly. We had big displacement up above a swing high. We came down into a fib level. And with that fib level, what is this right here? A fair value gap. But that was the inverse fair value gap. Now when price trades above a fair value gap and closes above it, if it's a bearish fair value gap, hold on, I don't let me take it back. Let me just slow down a little bit because I don't want to make this too confusing. Again, you have your fair value gaps. You have your bullish fair value gap, like this. Mark this out. This would be a bullish fair value gap because price is moving up. Okay. And this right here, this gap, let me hide my drawings real quick. This gap right between where this candle and this candle do not touch, there's a gap in there. That's a bearish fair value gap because price is moving down. But you can inverse them, like for example, when price goes up, closes above it, you have your candle closes with an up close candle. They close at the top. So price comes back down into an inverse fair value gap and the top of a fib level plus a bullish fair value gap. After displacing higher, which is a good sign because you want to see price. Wow, there's so much information that I want to put in this video, but at the same time, I don't want to overload it. So let me slow it down a little bit. Okay. This might be a long video. Oh, it won't be too long, I promise. So on a higher time frame, let's just do this. So we had bearish market structure. Right now there's so much I want to say because there's so much that goes into price action and market structure. But right now I'll just talk about lows and highs. I'll just keep it simple. It's like an onion. We're going to peel off layer by layer. Okay, and then we're going to get to the core. We're going to get to the core of the onion. And once you get there, that's where your life will change. That's where your life will change. But back to what I was saying. We have a high here, low broken. This swing high, low broken. Now you might ask yourself, well, these highs got broken. These highs got broken. Isn't that bullish? Doesn't it mean it's going up? No. Because what do we have here? What is this? This is liquidity. And the market came up just to take the liquidity. Because it's not just about if the market trades above a high or trades above a low. What comes first is what we talked about yesterday. Where is price headed to? Where is price drawing to? This might not be a good analogy, but if you have a destination You know, if you're driving somewhere, you know, or even if you're not driving, no matter where you're going, you have a set destination. Now, there's going to be different things that happen in life. There's going to be different things that come up, different ways and different routes you have to take, but you still have your destination. You know. So with this, what I'm trying to say is, the market has a destination. Don't worry about all the little things in between if you know where you're going. You know, the market is going down, okay? But it's still going to come up sometimes. You know, say you're headed to your destination, you know, in life you're trying to head on the way up. There's still going to be setbacks, there's still going to be things that, you know, unexpected challenges and things that come up, but you still know where you're going. So the market, you have to inverse that. If you're going short, you have to inverse that. The market's going down, so there's still going to be little moves up, but where is it headed? Okay, you have to get to one destination before you go to the next one. So the market has a destination right here at the bottom. This is where it stopped at. Let's go to the daily chart and just see where we're at. So the market had a destination. It wanted to take out these lows, and these lows. Now this might seem like a lot, but just bear with me. All this stuff is gonna make sense. Rewatch the video if you have to. Study. Go into your charts. Look for this stuff. The market came down to here. It had an objective. Man, this might be a long video. Oh well. Now I would make 2-hour long videos every night, but I know there's so many of you out there that will not watch it. You won't spend 2 hours. Some of you will, but the majority of people in life, no, they're gonna do the bare minimum. You know, and as much as I don't like that, I made this video series so easy. I'm trying to make it so easy that even your dog could trade. Unlimited treats for your dog. Dog treats for days. Maybe your dog will retire you. But think about this. You want to have your areas of liquidity. You have an area right here. Just imagine. The market comes down here. It goes below that. It comes to that level. You want to be thinking to yourself, okay, how is it going to react? Is it going to shoot up from here? If it does shoot up, okay, then the objective was met. If it keeps going lower and market structure hasn't been broken, if market structure doesn't get broken, then its next objective is the next low, or a fib retracement, or the next order block, or the next fair value gap. And once it gets to there, you have to look and see, does the market structure shift? Okay? Now, a market structure shift is just like this. We come down, we have an objective that was met. What did price do when we got to the objective? Traded higher, displaced higher, came down, took out a high. So when the market takes out a high with aggression, that's a market structure shift. So the market was taking out lows. We hit an area where, okay, what does the market want to do here? Nice move up, but you want to be patient. You don't want to You don't want to just get in right here. Because what do people do? They enter the market right here. They say to themselves, oh, it's going to keep going up. No. You're greedy. You're not patient. And that's why things like this happen. Look, they lost. People buy up here and they lose their money, and then it comes down to they think it's going down and they short. You have to be patient. Wait for a market structure shift. The market has shifted. Above this high, the market structure has shifted. The light bulb should go off. Okay, we've reached an objective of liquidity, of an order block, of a fair value gap, of a fib level, something of that nature. What does the market do? It comes up. Okay, now we wait. Does it trade above this high? Does the market structure want to shift? Yes. Right here, the market structure shifts when it comes above this. Okay. Now we want to enter the trade. Where do we wait for an enter? Where do we want to enter at? Comes down into a inverse fair value gap, touches the top of a fib level. Okay, that's on the higher time frame. Now let's go down into the 5-minute and fine tune our entry to minimize our risk. What's this on the lower time frame? Same thing. These things, they repeat on every time frame, every single day. So the market comes up. You want to start with the higher time frame and then look for the same thing on the lower time frame. Displacement up. After coming down into a fib level. No, that would have been enough for me. After that, after already seeing market structure shift above that, come down into an inverse fair value gap and touch the top of a fib level. That's all I need. And then once I see us just place up like that, come back down into a fib level on the lower time frame, plus the order block and a fair value gap. Yeah, I'm in there. I'm in that trade. I'm entering right there. All right. And I'm taking my first profit target above this high. That's what I'm aiming for. All right. That's what I'm aiming for. And then my next profit. Now I'll get more into price targets, but my next profit target would be, this consolidation area right in here, or this inverse fair value gap. This little thing. Hold up. This little thing right here. Look at that. Where does price go to? Look at that gap. Price comes into the gap, trades down. Let's go to a lower time frame. Let's look at the 1 minute. So look. Let me clear all this stuff out. Say you didn't want to enter there. We come up. We break market structure above this high. And now you can't just go into a chart and say, oh, we broke market structure. There has to be layers to it. You have to have that higher time frame market structure shift. The draw on liquidity completed for a sell. Draw on liquidity. Let me say that in an easier way. The draw on liquidity, the downside objective was completed. Now it wants to go up. Now we look for a market structure shift. So we came up above this high right here. Okay, and now what do? Go from the low to the high. What else do we have? Now, you might say, oh, well, why not this low? Well, look, the market moved up and it formed a base, a low. Look at that. See that? We go from things like that. I hope that makes sense to you. This is one price leg. Okay. See how it comes up and stops. Okay. Consolidates. Okay. So this area right here, this, look, this, I'll mark it out for you. This area, make it yellow. See this? The first price leg, the first move, you stop, you chop around, okay? So this would be that you could draw your fib from here. And then look, we have another move up, okay? And then chops around. We have another price leg, okay? But look, while I have this up, now with an order block, with order blocks, it's going to be the last down close candle before a move up. So this candle. But what you can also do is, if you have a candle like that as your order block, and it's just a little small little body candle like that, and you have a huge candle like that, you can use them both as an order block. So both of these will be used as the order block. Okay, let's drag that over. And I know some of you are watching this and just like, it can't be that easy. It is that easy. The real problems in trading, the hardest part, comes from you. It's battling the man or the woman in the mirror. Dealing with your own psychology. We're going to talk about market psychology later on, but so we come down into a fib level, plus an order block. After a market structure shift, after the market structure is shifted right here, come down into that. And then we also have right in here, what is that? That little tiny gap of a fair value gap. See how this top of this candle isn't touching the bottom of that? That's your fair value gap right in there. And then price comes up. It comes back down where? Where does it come back down to before heading up again? Right back into the order block. Right back into the fib. And right back into the fair value gap. Before going up. Going up again. And then we come back into the order block and go higher. And that's where I'm at right now. And then goes up and comes back into the fib level again. Now, man, I'm gonna go deeper into these things and flesh everything out and break everything down. But that's the end of today's video. Go ahead and study. Go into your charts. Look for market structure shifts. Now, look for market structure shifts. And now also, like I said, the draw is. I'll just say one more thing. Now, like I said, the draw is the most important thing. So right here, you might say, oh well, it came down below this low right here, or it came down below this low. Isn't the market structure shifting? No, because the market has an objective. If the market has completed its objective, gone to an obvious level, only then, look, I'm gonna take all this stuff off. Only then do you look for a market structure shift, you should be bearish. You should be bearish after that. Let's just take a look at where that would have put us. That red line. So we have a fair value gap right here. So look where price stopped at. Came up in that fair value gap. So yeah, that would have been probably a good area to be expecting a reversal. But like I said, the higher time frames come first. So don't just look for a market structure shift on a lower time frame. First, look for it on a higher time frame. Because market structure is still bullish on the higher time frame. Now, for us to be bearish, now really bearish, we'd have to break this low. Or even this low. But that's it for tonight's video. Go ahead and study the market structure shifting. Actually, I'm gonna go over one more example. I'll go over one more example. Let me go to a random day. Just stop anywhere. Or let me, oh, actually this. Okay, so we're going up. Price is moving up. Okay. Just focus on this right here. Just in here. Price comes up above a high, comes down. It's reacting off the bullish fair value gap, comes up. It's holding these fair value gaps. The market structure hasn't broken. Now we come down. We're still respecting, these fair value gaps in here. Still respecting that. Price comes up, trades down. So it disrespected that fair value gap. This is when your sign's like, okay, maybe market structure is about to shift. You come up, and this is your sign right here. Look how price traded below that low, and then look at the bearish fair value gap. Look how price came in, didn't want to go above that, and came down, traded below that low. Your market structure is shifted. Okay. Comes back up into where? Before going lower? A fair value gap. Look at the bodies of the candles. They didn't even want to get into that fair value gap. Write this down in your notes. Whenever you have a fair value gap and price doesn't even want to get, the bodies don't even want to get into the midpoint. Look, the middle of the fair value gap is this. That's the middle. I'll make that in red. That shows weakness. Comes down. Market is bearish. Market structure hasn't shifted. Now we traded above a high here. But what's our objective? We trade above a high here. Barely. Look at that little weak move. No. Bearish. There's an objective on price. and it's most likely this low. And you see price that obvious level, it comes down to the low, has a reaction up. Okay. Comes down to the order block. That could have been a little trade in there, but look how we come into the gap. There's a lot of stuff that goes into this stuff. Look, we come up into that. We come up into that fair value gap. Look, we don't even get to the midpoint. It trades lower. So you want to do things like this. Okay, we have a reaction off a level of liquidity. Now I want to see displacement higher, market structure broken, bearish fair value gaps inversed. So what you would want to see is it come above this and trade off of that. And it doesn't. Bearish fair value gaps. Yeah, let me stop here, because if I don't, this video isn't going all night. But yeah.